Welcome to my first ever YouTube video. First of many on my interpretations and opinions in finance, economics, and business. Today, we talk about my macro theory in today's modern economy. Right off the bat, I consider myself an Austrian libertarian, and I believe we are just around the corner from a detrimental sovereign debt crisis and a currency and liquidity crisis. Our debt-based economy suffers from monetary and fiscal policies, and they ultimately disrupt the free market economy. It also debases the value of fiat currency because dollars as the world reserve fiat paper currency have actually been a medium of exchange since Nixon took off the gold window in 1971. This is the beginning of a new fiat currency system, but even in the 60s and even in the 30s, it was illegal to hold on to your gold. The Federal Reserve may play the largest role of them all in this debt-based economy. See, in World War I, the U.S. federal government actually financed the war with borrowed money. This is where it all started. Money they did not necessarily have, and this included collecting through taxation, which was around 20%. Money printing was around 25%, and the other 50% went to U.S. Treasury bonds, right? U.S. Treasury bonds. It's because of the establishment of the Federal Reserve Act of 1913 that the Fed continues to monetize the debt with more debt because there's nothing else they could do, right? There's nothing they could do to service all of this accumulated debt and deficits. And we're not even going to talk about the trade deficits, right? That's been fairly stagnant relative to the budget. We used to be the world's largest creditor nation in the entire globe. But now, because of the responses the federal government has taken, inevitable cyclical economic recessions are essentially combined into one huge lump sum depression. If that's not enough, it's kind of crazy because out of every dollar the Fed collects through taxation, they actually spend over at least 50 cents of that dollar, so probably about now 60 cents on the dollar. So the amount the US invests and receives in income relative to how much it consumes and spends is just dramatically low because of government guarantees, guaranteed loans, deferrals, student debt mortgage reliefs, all these non-essential, ruthless, non-productive uses of fake money. And this gives taxpayers a very false pretense on what their personal balance sheet entails. This is just the tip of the iceberg, folks. I've dedicated rigorous hours to really understand all aspects of the economic machine and financial markets by retaining as much information as humanly possible and reading books and all these things. So that's one of the reasons I love this stuff, and there's no limit to what you can learn here, right? Something new happens every day, every minute. And it's because of this I learned that time truly is the most valuable commodity to ever exist. All right, let's move on to some of today's findings and insights and some general interpretations. So here's a quick market flash, some economic data that came out today, that should be taken note of is number one, S&P 500 closed at new all-time highs. The NASDAQ 100 closed at new all-time highs. Dow Jones Industrial Average closed at new all-time highs. The Russell 2000 closed at new all-time highs. Okay, so volatility closed sub 20. It's actually forming a little bit of support around that 20. U.S. Treasury yields are down. U.S. Treasury bonds are up. The dollar is trading sub 90 and is also forming a sort of support. The next level of support is around 89 that most currency traders are watching. That's the most obvious level of next support for the dollar to test. Now, don't forget, the trade-weighted US dollar is actually mainly comprised of the euro. So obviously the euro and the dollar are extremely related to each other. in terms of its inverse relation, right? So when the dollar goes down, that typically appreciates the euro, and vice versa. And so I wanted to get back to some economic data that came out today, and we'll start with South Africa's GDP rate. Not necessarily year over year, but quarter over quarter in Q3 was plus 66.1%. I'll say that again. A quarter over quarter in Q3, GDP growth rate of 66.1%, with a 54% forecast, and the previous GDP number was negative 51.7%. And the year over year Q3, they're still at negative 6%. So there's still negative yielding GDP growth. So these huge swings in GDP growth is, I mean, the result of it is normal because we already saw such a huge drawdown in GDP. It's shouldn't be too surprising to see a huge climb back to the upside, but they're still down on the year by 6%. So there's still more room to run. And, South Africa is an emerging economy technically. So, right. So also the Euro area's GDP growth rate Q over Q in Q3 flipped back to positive territory at 12.5%, with 12.6% forecasts, and the previous GDP number was negative 11.7%. So the euro Q over Q actually flipped to positive territory as well. Japan's core machinery orders in the month of October went from negative 4.4% to 17.1%, from negative 4.4 to positive 17.1%. The forecast was only for plus 2.5%. So it actually beat expectations by 15%. And by the way, this should be pointed out for Japan's core machinery orders. This metric actually excludes ships and electric power companies, and it's actually, specifically to Japan's core machinery orders, it's actually the largest monthly increase since 1996. Some other data that came out that is important, I didn't necessarily take note of because I saw it after I finished the video, is China actually reported deflation, right? They reported negative CPI metric. Now we all know that CPI as well as core CPI are not necessarily valid metrics to determine real inflation. But that's what everybody uses. That's what the federal government uses. So it's at least a benchmark as to where we're headed, as to where we are. Right, so let's kind of move on here. And here we have S&P 500, accelerating its dividend increases. You could see from, February to March, right, we had that huge black swan moment, and that took direct impact on companies paying out dividends to their shareholders, and they had to cut back on how much they paid. They had to retain more cash so they can not go bankrupt, and try not to borrow money so they don't go insolvent. So that's exactly what a lot of these companies did. And that's besides from the federal government bailing out all these businesses through a variety of different programs, but we'll get to that at another video. And apparently the worst is over for dividend investors, right? And I also want to make very clear about the debasement of the U.S. dollar and its purchasing power and the price discovery factors. 20 years after the Fed was established, FDR's executive order actually made it illegal to hold coins or bullions, like I said earlier. And then just 10 years after FDR, Bretton Woods established the US dollar as the world's reserve currency. So negative yielding sovereign debt of $18 trillion, and that's including what most recently happened with Portugal, where they reported their first ever negative 10-year yield with a debt to GDP ratio of almost 140%, almost at par with the United States, and $160 trillion in unfunded liabilities. It will take a couple, for the US, it will take a couple generations at the very least to pay off this massive debt accumulation. It's not happening. So, which is why, in a debt-based economy, you pay off debt with more debt. That's inflationary, right? So here we have, you can see here that the amount of call options people are buying relative to puts is massively out of proportion. And it doesn't look like it wants to stop, right? I mean, it's already, it's never been this high since the internet bubble, right? So, and speaking of which, one term that would best describe this is a term Alan Greenspan, former Fed chair and longest serving Fed chair, used the following phrase: irrational exuberance. And it became very, very famous, and it's probably extremely popular today. He used this term to actually describe the buying frenzy that we see today, but 20 years ago in the dot-com bubble. There is obviously a huge triumph of liquidity over fundamentals. Don't forget the stock market represents not even 10% of the nation's wealth. And even that is extremely exaggerated of a percentage. We still have 20 million people on unemployment benefits. The black swan event, or COVID, that actually pricked the massively prolonged accumulated debt bubble, has exacerbated the wealth gap to a very wide and diverging and frightening range. The smart money is getting out while the dumb money is pouring on in, right? Because their financial advisors are telling them to. We're in a new bull market. So none of this makes sense. And it's not necessarily supposed to make sense. That is why the stock market in particular is efficiently inefficient. Right? So I hope you have a great day. Please like and comment on this video to support my upcoming content. And this video is for educational purposes only. I am not a financial advisor, and everything I say is my opinion only. All right, I appreciate it, guys. Thank you very much.